Let's get into it today. We're going to be talking about the Fed rate cut, what this might mean for investment markets. And there's a lot of news to break down. So we're going to bring in a market analyst that I think you guys are going to want to listen to. She's got some good insights on where this market is going. You guys are going to love it. Let's just get right into it. I want to bring in Rebecca Walser, who is coming in from the Walser Group. How are you, Rebecca?
I'm good. Thank you for having me again, Paul. I really appreciate being here.
Yeah, so we've got a couple of things happening in the market right now as we record this morning. Of course, we're seeing all sorts of things around the government shutdown. We'll talk about that in a second. I want to get into a few points, though, and I'm going to share a couple of screenshots with you just in general of where maybe the Fed could be going. This one right here is one I want to kind of flow on. And this, of course, is the BlackRock CIO, Rick Reeder. He's predicting that we're going to get a Fed rate cut, but it is still a little bit uncertain as to how that's going to occur. Based on what you're seeing right now, and granted, we'll talk about government data being pretty much absent right now for Chair Powell to be able to kind of assess this. How does the Fed play this going into December, just around the corner?
You know, it's really difficult because you're talking about a situation where we have potentially, I guess the best one singular word to describe it would be stagflation, Paul. And the reason for
Yep.
that is that we have such upward momentum in markets, yet on the retail or on the invest or on the actual home household side, we have a lot of consternation to the downside, right? We have a lot of issues, especially if you're not in the top, even 5% of the economy. So then you combine that with a government shutdown that has obviously taken away all of their official data that they rely upon, other than they recalled the BLS staff to give us the Q3 numbers because they had to have that for Social Security to adjust the
Right.
COLA that has to be announced by law every November 1st. So we got limited September and Q3 data. And so you've got a Fed that doesn't have this data. Now, if the government reopens and they can start getting this data back, that's great. But we're talking about, data that has to be assessed and basically processed by the December meeting. And it's an early December meeting because it's 6 weeks, obviously, from the end of October meeting. So we're talking about December 10. And if you look at the Open Market Committee tool, we've only got a 65% chance right now of a 25 basis point cut from the 3.75 to 4 Fed funds range that we have right now. And so Powell, when you look at the actual vote at the October meeting, you had a 10 to 19 situation. So a very, very slim majority that authorized the cuts for October. And so you do have a lot of hawks in the Fed right now, really super concerned that the market is taking off at a tear, and yet everything else is still very depressed, and the weakness in the jobs. Now you're looking at Fed officials actually quoting private payroll. They're quoting ADP, and they're quoting, they're quoting all of the private. Oh, we've lost 135,000, 138,000, 153,000, depending on what you want to look at from October. And that's a problem because they don't have anything to combat that and say that's not the case. And so that would lend to accommodation, right? That would push the Fed in the direction of let's accommodate, let's help the labor markets, let's help recover. But there's also a little nuance that's happening. I don't know if you've picked up on it, Paul. I'm sure you have. But the nuance is that we have a lot of the hyperscalers and a lot of the Mag 7 that are actually cutting jobs and saying, hey, the advent of AI, and then they're not saying this, I'm saying this, with AI, we can continue to have these massive valuation run-ups without hiring the people back or even laying people off. So now what we would normally think of the Fed is let's go accommodative to help the labor markets. That might not help the labor markets if you've got these massive employers that are saying with technology improvements, we don't need to hire people back. So now the Fed has to wonder if they become accommodative, will that even make a difference? So you've got the people, Powell is really in such a corner. I don't think I've ever seen him in such a corner because he doesn't have data. He has hawkish people that are super concerned about the massive run up in valuations with the bottom, or I would say maybe 75% of the country actually economically struggling. And then maybe that's not even enough. And then on top of that, if he does go against all of that and try to which he doesn't want to help the Trump administration. This is no friend of Trump. His
Yeah.
term is ending in May. If he does go accommodative, it might not even have an impact on the labor market. Yet I will tell you that it will absolutely make yields go up. And that's because there's too much risk. The world is assessing the debt and saying, if you become accommodative again, we are going to just price the risk back in because it's just too risky.
Yeah. Well, and a couple of points that you're hitting on, of course, one is the jobs debacle that we're dealing with right now. There, and I would agree with you. I think we may be entering just a new category era of where jobs are going to be generated and created from. And right now, the problem is that the data is kind of in a crossover mode of registering less job data, but job information, but it's also being done by companies who are hiring less people because they've obviously started to utilize a lot of AI tools. I mean, even our own business has already done that. So it seems indicative of kind of putting the Fed in a very bad point. Why do you think then that you have this right here where Stephen Mirren is calling for a 50? Explain that to me because I just don't necessarily understand how something could actually happen around a 50 basis point if what you're saying is true in the sense that maybe the Fed rate cut would not even affect the job market.
Yeah, so obviously he's our newest appointment by this president, and he's certainly mirroring Trump's economic theories and philosophies. And I think what he's basically saying is, and I don't think this is a labor issue at all for him. Regardless of what he says, I think what he is saying is,
Yeah.
if you will remember, Paul, Trump was calling for an over 300 basis point cut
Hmm.
earlier in the year. That
Hmm.
had nothing to do with inflation or jobs and everything to do with the fact that we cannot afford to finance our
Yeah.
government
It's
and
the debt cliff.
continuously. That's what it is.
Yep.
We cannot, people are not understanding that we have had a massive monetary change since from Biden to Trump. We went to modern monetary theory in 2009 after the GFC, and we have been stimulating until the stimulus after coronavirus was so massive and so much that they had to call it transitory and hide it for a year. When then they finally admitted the truth, we got the highest raises ever in the history of the Fed between 2022 and 2023 because the inflation was there and it was unbearable. I mean, we were over 9% at one point. So they tapped that back down, and they did that by raising rates. Well, the problem is when you finance almost $10 trillion over a period of time since 2009
Right.
at what we call Fed funds of 25 basis points, and we don't pay off anything. Like, remember that we are increasing our debt every year by $2 trillion. So we're never paying off principal. All we're doing is issuing new paper to pay off the old paper. When you're paying off old paper that was written at 25 Fed funds rate at now, a 4.2545 funds rate,
Yeah.
you can't afford to do that. So what ends up happening is you decide that you have to now finance everything in your government off the short end of the curve, 2 years or less,
Yep.
treasuries or T-bills or or less. And that's the problem. We can't afford anymore to refinance our debt on the long end of the curve. And that is economically and mathematically totally not viable. And he's coming from the perspective of, we have got to get rates down for how much trillions of debt we have. We can't afford to service the interest on this at this level.
So, okay, so here's my question. Does the administration simply say we want to reposition how the Fed is being involved in this? Because to your point, you're talking about an 8x cost basis on just being able to get the debt cliff back in order to this point, or is it a possibility that we could just see a massive shift over into other assets? Obviously, you talk a lot about Bitcoin, gold, et cetera. But if you look at what Morgan was saying, let me kind of share this with you. JP Morgan comes in with this statement, which is kind of interesting, seeing Bitcoin as more attractive than gold after this most recent price dip. So I guess the valuation at around 100,000 has dropped into where JP Morgan is saying this is maybe an opportunity where you could come in and see something. But here's my question. When you look at where gold is, where digital assets are in general, then you look at this right here, ETFs now starting to take over. And we're also starting to see a lot of Bitcoin exodus now moving into other digital assets. So you've got Solana, Ethereum, XRP, which is all leaning into these ETFs that are brewing. What's your opinion? Do you think the government is maybe setting up for either a strategic reserve, whether it's gold, digital assets, to try to offset some of what's going on right now? What would be your strategy for this?
This is the question of the day. This is the monetary question of the millennia, Paul, what
Yeah,
you're talking about right now. Because what you're talking about is really a currency transition. Okay.
yeah,
This is what we're talking about. We are talking about leaving behind fiat fractional reserve currency that you trust, that we don't verify, the gold reserves. We don't verify how much actual, if you look at, unfortunately, if you look at the FDIC balance sheet and you look at the actual hard reserves and reserves, there's less than 2% of all FDIC insured reserves that actually have
right.
reserves for them. That is not even to talk about all of the accounts that are beyond the FDIC insurance, that like when we had three of the largest bank failures, in 2020,
Mhm.
2021, three of the largest four ever. The one previous to that, obviously, being with the global financial crisis. And the fact is that we don't know how much actual capital we have that backs anything up. So when you're talking about moving to the blockchain, which is verifiable, everyone can independently go and see what is going on, then you're talking about a different situation. And the fact that, and I know we're going to talk about some of the regulatory reforms that are coming for these technologies, but the fact that the Genius Act alone required a one-to-one reserve. So I'll let you, any third party issue, with the exception of banks, as an outlier, but we'll talk about that. We'll let you issue a stable coin, but in order to issue that stable coin and have it have the effect of what a stable coin is, it needs to be in reserve, backed up 1-to-1 with either a short-term treasury or actual
Right.
US dollars. And so the question is, how exactly economically are we going to leverage the blockchain, stablecoins, the new technology for cryptocurrency to fix our debt problem? And, at the highest and most simplest level to explain it, because it's very complicated, even for you and I, to get into the weeds of how this is the machinations of how this is actually going to happen and come to
Mhm.
fruition. We're talking about, minds that, like, I would like when I consult Nikolai Tesla or somebody like that. Like I need Einstein. We need the most brain trust we've ever had ever in the history of time. But what I would just say is that it seems to me that you could have the US government sort of opening up the coffers and saying, who wants to issue, excuse me, Paul, getting a cold down here, it's getting cold. Who wants to issue new currency? You have to buy our US debt in order to
Yeah.
issue that new currency, so that you could, in theory, retire a ton of $37 trillion, because you could have issuers come in and buy $37 trillion of debt. But the machinations as you work through that are very complicated. But I will say that seems to be the direction that we are headed. And the implications of that are vast. And one thing I will just say as a tax lawyer that I want to just make sure I get in here, because sometimes these tax points get lost. ETFs are literally pass-through entities to the asset class. For
Yeah.
example, holding the gold ETF, a lot of investors don't understand that you're taxed as a collectible on that, because if the only thing in that ETF is actual gold, then
Right.
the IRS and the government looks through the ETF structure and doesn't say, oh, this is an investment. Say, no, this is an actual commodity that you own, and it is taxed as a commodity. So people just need to understand that ETFs are looked at. And now if you have a multiple asset classes, then it doesn't always apply, but if you have just a specific asset class in an ETF, and that's the only thing there, it will be taxed as that asset class is owned directly, and that has tax implications.
How does that Okay, so with all that being said, because you're talking about a monetary shift right now in a position where it could possibly refinance the US debt, maybe through the vein of a lot of these stablecoin companies. But at the same time, you've got all this flow moving into Wall Street right now on ETFs. And I'll show something I think is pertinent to today. Look at this data right here. This is a little bit crazy. This is 40 billion right now, 5 days. This is piling into equities. Bitcoin ETFs are turning positive. You look at this along with the new ETFs coming in on Solana. BSOL, of course, just goes off the charts with Bitwise. XRP is getting ready to land this week, and next week will be piling in as Bitwise, Canary Capital, all those guys kind of come into it. What would be so? I guess the point is that when you look at how investors are trying to hedge the dollar, obviously gold, maybe even physical gold and silver, digital assets, Bitcoin, now ETFs, all in this one big basket of this is the way to beat inflation, which is coming. How close are you, do you think, or I should say, how close are we, do you think, that we could see an even higher inflation number that could be accepted by the Fed? Because they're already talking about this 3% now as the new floor. What are your thoughts there?
I mean, there is no doubt from an economic perspective that we cannot maintain a 2% inflation rate. It is over. That ship has sailed. You cannot hyperinflate your currency as we have done from the 70s forward to present day and think that you'll be able to artificially maintain 2%. Powell has already been how do I say, socially conditioning the
Yeah.
U.S. population through his Jackson Hole speech last
Hmm.
year to let people know that the 2% inflationary rate is an issue. And he's also really attacked, rightfully so, the dual mandate, because the dual mandate are really an opposite of each other. They're in conflict. Like, how can I maintain labor at a stability of, 4% or less
Right.
unemployment, but yet also keep inflation at 2%? So there is no doubt that the inflationary number must come up beyond 2%. What they've done to manage this right now, Paul, is unfortunately they've just messed so much with the actual COI numbers, the cost of it. They have obviously changed core and let's remove food and energy, and they've
Yeah.
finagled it in every way that they
Massage it.
can. They've changed the basket of goods that they're tracking. They've done so many things to try to help us see if we're around 2%, but it's impossible. The other thing that you're not going to have is you're not going to have AI and massive hyper scaling of GDP, which is what everyone projects AI will do. And by the way, it must do it if we are not going to file for bankruptcy in the United States of America. If we are not
Yeah.
going to become insolvent, we must have AI have GDP that is so exponentially larger than the cost to generate it. So that has to be. But I worry about investors from the perspective of going into an ETF. So the democratization, rather, if you will, of cryptocurrency, right?
Hmm.
Before, it was your listeners. It was the people that were in the know because they sought out the information. They wanted to know. And of course, it's become a lot more mainstream. But as it got democratized into ETFs, I feel like you have a lot of lay people that aren't aware, that don't listen to podcasts, that have no comprehension. They're saying, oh, well, if it's in an ETF now on my 401k available, the SEC must be sanctioning this as an actual investment that is okay. And that is not the case at all. As you know, the regulatory framework is so threadbare, and we have only really gotten the Genius Act. We have a lot more regulatory reform coming, but
Yeah.
I don't want investors to think that this is now safe, or this is still a risk-on asset. And I know this is the future and this is where we're headed. But to say that we have use cases, I mean, look what happened with Bitcoin just this last month in October,
Yeah.
October 10, when you had China basically say, we're going to become protectionist against the rare earth minerals. Bitcoin massively dropped. Now, how is Bitcoin dropping because China becomes protective of rare earth minerals? And it's obviously because Trump retaliated. Oh, new tariffs for China, direct trade war. And then what does that mean? Demand is going to drop and Bitcoin's value drop precipitously. So a lot of people call Bitcoin, and I'm a fan. Believe me, I don't want to sound negative here, but I want to be honest. Bitcoin is referred to as digital gold. And the fact is that when you see something like that, we don't have enough use case going through, Paul, different stock and gyrations, different economic gyrations to see how is this truly going to perform. I'm a fan. I believe it's going to happen on the long term, but I believe more so it's going to happen for two reasons. One, it's just absolutely superior technology. I mean, the idea of me having to contact my bank with a form. I'm not kidding you. I'm a member of one of the largest credit union in the entire United States. I have to contact them with the form. I have to send it in. They get 48
It's
hours to
ridiculous.
approve it. They're now asking me what the wire is for, which is none of their business, and they should shut their pie hole on that. And then they can take another 2 days to actually send my wire. When I can, and I know it's not
Yep.
the blockchain yet, but I can Cash App, Apple Pay, Zelle, Venmo. There's so many traditional already alternative payment streams that aren't even on the blockchain that the blockchain is going to happen. It is here. It is unstoppable. It will happen. However, it is going to be rocky. It is going to be bumpy. If you think the players that are invested on the traditional finance side are going to go down without a fight, we've already seen the American Banking Association,
Oh, they're
attack.
fighting in big
We've,
time.
we've already seen them attack the Genius Act because they read the writing on the wall. The writing on the wall is your time is coming to an end.
Yeah.
We're not going to need you anymore. I was at first worried. I wasn't sure when we were at the very beginning stages and we thought maybe there was going to be a Federal Reserve central bank digital currency, and I was worried about all the privacy. But the second they said stablecoin and put it back into third-party hands, I thought, okay, that's how they're going to get around any kind of government direction. So now that we know we've got third-party issuers of stablecoin and other things that will be, will be payment processed available very soon in short order. This is going to probably be a slow but then very fast transition.
That's kind of what we're seeing is slow and then all at once, because the key here is you've got a lot of integrations that are happening. To your point, the big one, of course, is going to be the Clarity Act. This was the CIO of Bitwise. He had basically, Matt Hogan, we just had him on the show the other day. He basically came in and said, this is the situation. We are in for possibly a repositioning of the entire market again. So he is calling for the Trump admin to deliver a little bit more clarity here. But the big one is that right there, is he believes that this could deliver a huge bull run to continue forward. If that is the case, if in fact that we get in a position right now, and I want to play a clip for you because this is the Clarity Act possibility of how this plays out, because all this could all accelerate once we see the government come open. And I want to get your take on when and if we see this occur, which I believe is going to happen. What kind of impact is this going to have on the traditional investor class out there? Let me play this for you real quick, and we'll bring it in.
Finally reopens this week. We're expecting Congress can take on the Clarity Act, the long-awaited crypto market regulation bill. Bipartisan talks reportedly resuming in the Senate. Mr. Chairman, what can you tell us? Because no doubt a reopening is good for financial services and for crypto as well, right?
You bet, because we have pending before the Congress a National Defense Authorization Bill trying to prepare the ag damage to our economy from no farm bill during the Biden administration, no Biden enforcement of the Chinese soybeans deal. We need an ag bill, and that's another reason to open to Congress. You're right. We've made progress during September and October on market structure for digital assets. The Clarity Act, which we passed with 78 Democrats in the House back in July, is now subject of intensive work in the Senate by both Senate Democrats and Republicans on the Banking Committee and on the Senate Agriculture Committee. They're making strong progress, and I hope we can conclude that in coming days. It's been hurt by the shutdown, so I'm looking forward to working with them and getting it across the floor and to President Trump's desk.
Okay.
All right, so you saw it right there. They think this is going to happen. This is most likely going to open up the dam on the number of new products entering the market, including from traditional finance companies out there, traditional investing companies. This will affect even businesses like yours. How big? Well, I guess the real question is how fast do you think this could really take hold in our financial environment that we're in right now?
Well, I mean, I think that it is. I'm going to be hyperbolic about this. This is the beginning of the end of the existing system, and as people realize that they can completely operate on the blockchain, and as that capability comes to actual fruition, I no longer am using. And I know Visa and MasterCard are trying to become players in this game. I know they are now, right? But let's talk about just their traditional networks. The sooner I can say, hey, I'm going to go pay for my gas with my blockchain currency and not Visa or MasterCard,
Mm-hmm. Yeah.
I am going to move over. So what this is the end. This is the end of the traditional financial companies as we know them to be. Now, some of them are going to get smart and they're going to try to enter the market and be one of the players. And it's early enough in the game that could happen, Paul. But here's the problem they're going to have. Every step and move they make towards the new system takes
Yep.
them away from the business model that is making them money and a profit. And so they are going to have such a conflict to their shareholders even. How do we stop doing these kinds of things that make us these fees and this money and move to this? But we have to move to this because if not, we're left behind and we're completely done.
You get, well, this has been done before in the era of when the internet was really born. The problem, to your point, was that many of the companies who were trying to adopt this next generation fell behind because they had two businesses to run. They had the old, we'll call it Web 1 and the new Web 2 version. Now you have the old Web 2 version and the new Web 3 version that essentially is the internet of value. I think it's going to be the newcomers again, because it was the newcomers the last time that won, and that was Amazon, that was Oracle, that was, Salesforce. If you look at what Benioff has done, obviously what we're going to see now coming out of this is companies like NVIDIA, Palantir, all the blockchain organizations, Ripple, and so on, that are going to basically become the new infrastructure going forward. With that being the case, if that were to be the case, to your very point there, is because we haven't seen this in the financial infrastructure before. In previous cycles, we saw the revolution of e-commerce. Sure, we saw the revolution of communication through mobile and social, but we've never seen an infrastructure change. What happens when that occurs? Because this is something that's been built on for the last 50 years. What do you think?
I mean, it is the changing of our financial system. It's really a currency change. I mean, we are literally changing what currency we leverage. I'm not suggesting that the US dollar will go away. I'm suggesting that the US dollar will probably become almost like a gold, a reserve. It will become. No problem.
I'm sorry. I was going to play this for you because I think it lays right into your point. Go ahead and make that, and we'll hit this clip.
The U.S. dollar is going to become more of a reserve and a barometer, but not an actual transactional based unit of measure of value anymore.
Yeah. With that being said, here is SoFi's CEO. Now, this is something that was a bit of a surprise, I think, to the market, and probably more of a bigger surprise to what is happening now with the bigger banks. This, of course, is a small neobank. Let me play this clip for you.
As well. Okay, so what's going on here? This is a big deal.
Yeah, this morning,
a big deal for you.
It is a very big deal. It's a big day and a big milestone. Reverses the course of time.
It does.
We've wanted to be a one-stop shop for all your financial services needs, and one of the holes we've had for the last 2 years was in cryptocurrency, the ability to buy, sell, and hold crypto. We were not allowed to do that as a bank. It was not permissible. But in March of this year, the OCC came out with an interpretive letter that it's now permissible for banks like SoFi to offer cryptocurrencies. So this morning we're launching, as the only national bank, the first and only national bank, the opportunity to buy, sell, and hold cryptocurrencies like Bitcoin, Ethereum, and Solana.
So I was going to ask, we're just talking about 3 for now?
We'll expand well beyond 3. It'll be a pretty broad assortment. We try to differentiate on being fast, having broad selection, great prices, ease of use. So we'll try to give members, SoFi members, as much selection as they would like.
And what's the difference between going through you and going through Coinbase or going through Robinhood or somebody else?
Yeah, there's a couple of really big differences. First, we're a nationally chartered bank, which means we have the infrastructure, the processes, the financial conditions that provides the safeguards that a consumer would expect from a bank, which is going to allow us to scale responsibly. The second thing is, because we are a one-stop shop, you can do all your banking, checking, and savings at SoFi, your borrowing, and your investing, and now crypto. And one of the unique things about that is when you come to SoFi and fund your crypto investments, you'll fund them in a SoFi checking and savings account. that checking and savings accounts deposits earn interest.
Say that again. You're going to fund it with crypto?
You're going to fund
your checking account.
You're going to fund your checking account with cash.
Okay.
And then when you buy Bitcoin or Solana or Ethereum, the money will come straight out of your checking and savings account. So when you're not putting cash to work, it's not sitting in an account that earns no interest, and it's not sitting in an account that's not insured. So the money will sit in an FDIC insured account up to $2 million is what we offer. And when you buy, it will instantly withdraw from that account and send it to the marketplace.
All right. So I mean, this is mind-boggling now, because you're talking about affecting companies like Plaid, who is the intertransfer between bank to bank or bank to organization. That is eliminated. If you're in the crypto business, I'm looking at Robinhood. I look at Coinbase, Gemini, all these guys who are going to immediately be affected because they are not sitting on a banking license, at least not yet. So you have that. Then you have the JP Morgans of this world. I mean, Jamie Dimon just announced he's doing JPM, and they're going to do transactions still in an isolated window, but they're going to do transactions over on Base. This seems like this is moving much faster, Rebecca, than maybe everybody gives it credit for. What do you think? A year from now, where do you think we are? Every bank in the land is going to have this? What do you think?
I mean, they must. They must. This is the end of the traditional system. Sofi obviously is uniquely positioned because of their origins and how they created themselves. And, it was interesting his answer to why he's a better alternative to Robinhood and all of the other, exchanges, Coinbase. He said, well, because we're a traditional bank and we have the infrastructure. None of that infrastructure matters anymore. We don't have a regulatory framework around this. It's going to be launched. The regulatory framework is going to have to be created and implemented on any provider of digital assets. So that is going to affect everybody universally across the board. And the fact is that this is iterative generations of banking, and this is what's happening. We are moving from what we are doing now to the blockchain. It is unstoppable at this point. It is unstoppable. The question is, what players are going to be like a Sofi and realize that the business model is changing so fast that we now have to operate over here on the traditional banking side, but get with this side and get the regulatory compliance ready to go in place, because it is going to be, I don't believe it's going to be a slow death at all. I believe that we're in the iteration right now of the generation of the ability to do payments on both sides of the aisle. And then people think this is going to die off slowly, but because I think this is going to happen extremely quickly, this traditional finance could be gone. I don't want to put a time frame on it, but I would be shocked. It's probably not going to even be 5 years. It is going to go fast.
Okay. Well, if you look at just the performance of some of the stablecoin companies just by themselves, one, of course, that we've been tracking, obviously, for a long time has been Circle. This is now, in comparison to some out there like RLUSD, which is being submitted by Ripple. But if you look at what's going on right here, I don't know if you saw these numbers. This is a good one right here. Let me show this data to you. It'll blow your mind. This right here is the Circle's Q3 earning report, okay? So the internet financial system, it's already here. 73 billion USDC in circulation. That was as the end of the period, 108% year over year. So they're already growing at a ridiculous rate, and we still don't have clarity, okay? So 9.6 trillion on-chain transactions. That's a 680% year over year growth. These are mind-boggling when you and I know that this is the tip. It's like the tip of the iceberg here with all this happening. And then you have new entries like RLUSD, what Ripple is doing, their announcement of G Treasury, all the different roll-ups that they've pulled into this game. I think it's to your point that we're going to deal with, I don't know, do you think the top 5 banks stay the top 5 banks?
There is no possibility of that happening. It is absolutely impossible. It's not going to happen. No.
Wow.
Jamie Dimon is probably the most advanced. And obviously, he is clearly creating a alternative universe within the JP Morgan framework to be able to be on the new frontier. So I would bet on JP Morgan as being in the mix. but they're
Mhm.
probably the only one that I would bet on. Absolutely. I mean, even if you look at not just,
Wow.
for example, on the Mag 7 and the hyperscalers, and let's look at Apple and its AI and how it
Mhm.
hasn't kept up. So
Yep.
you're going to see that across the
Good
board with
example. Yep.
you're going to see that across the board with financial institutions, and they're going to get left behind. You can't just decide, oh, I'm going to listen. This is the complete death of the old way and a complete new way. And it's the same thing that we're going through outside of the financial world in AI and everything else that we're doing in life. It's not going to be the old players just reinvent themselves and become new players. Now you can look at an Oracle who's trying to make deals and do all these things and become part of it. And I'm not counting Oracle out. I don't mean to dismiss them, but if you look at Oracle's debt to revenue, and they're going to have to literally raise capital or debt to finance all of the AI
Mhm.
investments that they're talking about making. They're no longer using cash flow
Right.
like we were previously using. So what I'm trying to show you is old players that try to become new players have a lot of challenges because they have a vested interest, Paul, to keep the old way alive as fast as possible. And guess what? The new players have no such interest. So they are going to move so much exponentially faster that if
Mhm.
you're a legacy player, you just cannot move that fast. And speed is what is going to win the day. You have to be the first adoptive generation, or you're gone. You're out.
Well,
You're gone.
it's interesting you say that because we're already seeing this right now. We saw it obviously in the e-commerce era where we saw all sorts of retail stores that just got decimated because of the evolution of where we were online. Now you're seeing it in, traditional media has been completely replanted now because of podcasting, YouTube, and all the different social media products that are out there, including what's happening on X. And now all of them, I mean, I looked at the data the other night and I was surprised at, because we track like the top 500 podcasts and just the top 20 podcast products out there in terms of media, we're outpacing CNN, CNBC, MSNBC together.
Yeah.
And I think you're in the same kind of boat now with a lot of these financial services. The question is who lives and dies by this new sword is going to be the one to watch. We're definitely going to have you back on because I think we're going to be seeing some of these winners start to show their head in the next year or so. So the likelihood of seeing something happen. Give me your last prediction. I want to get a couple of predictions from you. Let's go into December and January. We've already had 2 cuts, quarter basis points. What's your outlook right now for the Fed on the December and the January meetings?
I have a feeling that December, just the weight of the pressure is going to be too great to forego a cut. Although I do believe there are a lot of people that do not want a December cut in any way. They
Mhm.
just do not think that it is warranted given I guess I would have to say stock market because
Yeah.
really the economy itself is not a barometer of health. So I would have to say the stock market and how, I mean, we're talking about all-time highs again. It's just really hard to cut into that kind of thing. And the fact is that there's too much. They've experienced now since 2020. They've experienced too much change on how they operate the federal open market operations,
Yeah.
on how they have to finance the government debt and how they have to do all these things. And now they know that inflation can no longer be transitory. It can no longer be obscured. It can no longer be obfuscated. And so that means that it is important that they do not cut unnecessarily and create, a stagflation situation,
Yeah.
which we are approaching. And
Yeah.
so I think we will get a December cut just because I really believe it's already baked into the market. But beyond December, I think no. And I will just want to add
So no
on
on
the
January. No on January.
unless we get some kind of, like, they absolutely must be accommodative, I just cannot understand the economic
So
case.
you're thinking that Powell holds on strong on the end of his tenure
He
and
has
that
no reason not to really push his agenda, that's for sure.
okay. And that once that we get a new announcement of the chair, which I'm assuming is going to be assigned by the administration probably or after the first of the year, which will take over, I think, in May. Um, what do you think the lead up into May would look like? Do you think Powell will just continue to try to wreck? Or do you think that come May we get, a full 2 big basis points cuts.
I just don't see this. I just don't see Powell doing anything that would be very helpful to the Trump administration. The Trump administration massively wants cuts because they're dealing with the refinancing of our debt
Yeah.
problem. And
Yeah.
they're really just dealing with the monetary issues of dealing with a massive debt. So I don't see Powell trying to help Trump in any way. I do think that we are in this very unusual place. This is uncharted territory. We've never been here before, but this is the transition of our financial system. And so that is going to be uncharted. It is going to be massive. And it is happening already under the covers. And I think, and not that anyone's asked me for my advice at the CEO level of these traditional finance companies, but I would tell them, you cannot create a conflict of killing your business and creating a new business simultaneously. So what you
Yeah.
need to do is create a separate company, and you need to make it separate and distinctive. It can be under the umbrella, but it has to be its own machine rhythm, to not try to take your legacy company that is dependent on traditional finance and try to move it into the new era, because you will be left behind. You'll be too slow. You're going to move too sluggish. You're just not going to be able to keep pace with how fast this is going to go, and you will get left behind. So if that is your intention, to try to still be a player, go be a player in the new environment and the new sandbox. Don't try to drag and attach your sandbox to the new sandbox like a chain. It's not going to work. You will be left behind.
So the banks that are trying to do this right now, you're saying that this soft touch of dealing with this new transition is the wrong approach. It should be just pull the Band-Aid off, look at whether it's new offerings, maybe a whole new market structure, possibly new countries, out there in terms of going into the market. That's the model for them to take.
There's no benefit to offering somebody FDIC insurance. First of all, it's phantom insurance because it's not actually insured fully. We know that. There's no assets there. There's no money there.
Yeah.
And second of all, why do we need FDIC insurance when an issuer of stablecoin, which in a new regulatory framework that's coming will be verified by a federal entity?
Exactly. Yeah.
Why do we need
You
FDIC
don't need
insurance?
insurance when you have a one-to-one. Yeah,
If you
you're right.
have a one-to-one, insurance is unnecessary. So therefore, all we need is a federal regime of verification of asset deposits. And again, the blockchain, it's public knowledge. So we don't need the federal government protecting our deposits anymore from bank failures, because we're just going to exist in real currency that we're dealing with, digitally represented, but real absolute currency. None of this fractional reserve money multiplier. And that's the economic question of the life. How do you go from a fractional reserve money multiplier, service dominated, spending dominated, 70% of our GDP is retail and service consumption spending. How do you go from that, when you do it with a money multiplier effect, to one for one, our transactions are only our transactions, and we're not hyperinflating our money and creating this money multiplier effect? That's going to be the economic challenge, but there's not going to be a need anymore for traditional government insurance or whatever, because we just need to verify the funds are there, period.
Wow. Okay. So, whew, man, this is going to be a crazy wild ride. All of this happening while we're trying to do a debt refi. Current debt, I think, limit is like at 41 trillion, and the current debt's probably around 37 and a half right now, maybe 38.
Yeah.
So the likelihood of another ceiling crisis, that could still happen in 2026.
It will happen.
Yeah. Okay.
It will happen.
So that is
especially with the longest
it's the
shutdown
eminent.
ever.
Yeah.
The longest shutdown ever in history
Yeah.
over, SNAP benefits. And
It's out of
I've been
control.
flying. I literally came back from overseas, and I had to have 3 different airlines
Yeah.
for a
To
ticket
get you
because
home.
everything, I got home, but everything kept changing because of all.
Yeah.
And I'm just like,
Yeah. It's a little
wow,
crazy. Yeah.
it's
It's a little
nuts.
crazy right now. Last prediction to you. Which one does better in 2026? I'm just looking at gold and Bitcoin. What do you think? 2026 performance.
So
I
I
know
do
you're going to
think
say buy both.
I love for you to buy both. That's my ultimate recommendation. I would caution people to understand that Bitcoin is not necessarily digital gold, and here's why. 2026 will probably be the most bumpiest financial institution year we've ever seen in the history of time. And that's because this transaction and this transition is begun already, and we will be steamrolling in 2026. So you're
Yeah.
going to see a lot of disruption in financial markets next year because of this transition. And for that reason, I believe that Bitcoin does still right now act kind of as risk on. And so
Okay.
I would absolutely recommend that people hedge with a true, hard and true, going back to the Old Testament of the
Wow,
Bible,
physical.
a physical gold,
You're
or,
the second person that has said that in the last couple of days. I keep talking to analysts that are pushing towards physical
if
gold.
you just look at the Forex reserves and the ratio of that to our gold value, we really should probably be around $16,000 an ounce on gold,
Whoa.
just with the Forex. So I do believe that gold and silver, although they're not sexy, Paul, they are going to be on the other end of all of this as still the hard hedge
Well,
asset reserves that
yeah.
tether the world to reality.
Mhm.
So from that perspective, you cannot
Well, it's
ever
like
go wrong.
where's the safe spot? If we do see a meltdown in the S&P 500, where are people going to go, to protect asset? My concern is they're not going to go to the dollar if we're inflating at 3% to 5%.
No.
Then you'd have to literally restructure your entire balance sheet just to deal with that inflation. So is gold, Bitcoin, digital assets becoming the new hedge? Well, it's already been out there for quite a while. I think everybody watching our podcast
I'll
would
just
say
end with
yes.
this. I'll just say that, it's so funny to me, the people that are like, I don't understand. Gold has just performed so horrible over the last 50 years, 40 years. There's been no growth and blah, blah, blah. And obviously, if you just look at
Until what's happened recently.
That's what I'm saying. If you just look at GLD ETF, it's over 55% year to date.
Yeah.
Why? Because it is a peg, an unmovable peg, and a deep, deep well that can never be replaced by any other asset on planet Earth. Period. End of story. So if you need a tether to true north when you're going through a financial transition, this is that tether. This is
Might be.
probably gold and silver is probably the only tether. That's not to take away from the digital assets and how beautiful they're going to be after the transition. It's going to get ugly, but they're going to be beautiful after the transition. But through the transition, we have to have a tether to true north, and that is what our hard asset commodities will provide.
Interesting stuff. Rebecca Walser from the Walser Group. Make sure and you guys check her out over at the Walser Group. Rebecca, always love having you on. Thanks for coming in. We appreciate it.
Appreciate it. Thank you.
All right. You guys know what to do. If you're not already out there, subscribe to the show. Make sure and do that. One way you can do it, of course, is just by clicking the subscribe button right down below. The other thing, of course, is follow me out there on X. It's just @PaulBarron. I love to get your insights also on who you like have us having on the show. So make sure and hit me on the DMs there. We do vet everybody before we bring them on the show, but we've been getting quite a few of you guys in terms of recommendations. So thanks for that. We'll catch you next time right here on the PB Podcast. Take care.